Well, hello, everyone. Thank you so much for joining us again for Safe Money Radio. If this is your first time joining us, hey, we're so glad that you're here. We are the premier financial planning group in the Ozarks. We've been hosting Safe Money Radio for 15 years now, and we are grateful today to have a returning guest, my good friend, Don Graves, on the show with us. So, Don, thank you so much for joining us again today.
Thank you, Brad. It's my pleasure to be back.
Well, tell everybody a little bit about what you do. I know you speak all over the world, and I've seen you on LinkedIn. You've been going to a lot of different events and received some awards, and you've been doing some keynote speaking. And so tell everyone what you do.
You know how retirees sometimes get concerned about the possibility of running out of money in retirement? Well, that's what I do. I help them to access a fourth bucket of retirement income called home equity and use it in a way that it strengthens and lengthens the other retirement buckets. Now, I do it primarily through a tool called the reverse mortgage, or what I call the modern reverse mortgage. And so for the last 25 and one half years, that's what I've focused on, that's what I do, and that's what I teach about, is how to improve your retirement outcomes by using a reverse mortgage.
And of course, when people hear reverse mortgage, it reminds me in my world, because I write a lot of annuities and structure a lot of life insurance for people. And people are like, life insurance, annuities, reverse mortgages. I know I've heard you tell a story before about what happens when people hear reverse mortgage at a get together at a family party, and it just cracks me up. So why is it that you think people have this?
Well, and I said to folks, you ever mention reverse mortgage at the barbecue? I said, what happened? 3 people dove under the table, 3 people left the table, and your Aunt Janie made a shank out of a plastic knife and fork and came after you. And it's just dangerous to mention reverse mortgages in mixed company. Why is that? Well, the program started in 1961. And when you think about it, that's a lot of time for misconceptions, even abuse of something that's been around that long. Well, the federal government stepped in 1988, signed by Ronald Reagan, authorized by the 100th Congress. And so the reverse mortgage, I tell folks, it's not new, it's not dangerous, it's not spooky.
Yeah.
It's part of a government-sponsored, a 3-legged stool of a government-sponsored retirement: Social Security, Medicare, and the Home Equity Conversion Mortgage, HECM, and that's the federally insured reverse mortgage program. And so I hope today that your listeners will tune in long enough and that they're going to see and hear some things that I think is really going to shock them about what can be accomplished in retirement.
Here's what we're going to be talking about: 7 ways to improve your Social Security with a reverse mortgage. Now, you heard me correctly. Everyone wants to maximize their Social Security. We talk about it on this show all the time. We're going to be talking about 7 different ways to maximize that Social Security by using a reverse mortgage. And we have our good friend Don Graves with us. You can actually see his book here behind me, The Retiree's Guide to Housing Wealth: 5 Ways the New Reverse Mortgage is Changing Retirement. You want to call in and say, hey, I want to know more about that. How do I get in touch with Don? How do I come in and talk with Brad? Our number is 866-780-7233. Just call us anytime. We're going to be talking about 7 different ways to improve your Social Security with a reverse mortgage. So, Don, let's jump in with number 1. What's the first way that you can improve your Social Security with a reverse mortgage?
Would you allow me to go back just about 50 seconds?
Yeah.
And just review what is a reverse mortgage. I'm going to share my screen. Just to remind folks, IJAM, it's just a mortgage. It's just a mortgage. It's not new, dangerous, or spooky. The mortgage we're talking about today is called the Home Equity Conversion Mortgage. It's a federally insured version and 98% of all reverse mortgages. A non-recourse loan for those age 62 or better that allows them to convert a portion of their home's value, turn it into tax-free dollars without having to make any monthly payments, and you do not give up ownership or come off title to the home. The amount of money you get is always based on 3 things: the age of the youngest spouse, the value of the home, and the interest rate. And that's going to make some money available in the middle of the triangle. Any outstanding loans against the property gets paid off, and what's left is this GLOC, this growing line of credit. Now, Brad, that's what the foundation is going to be built on. So I wanted to just quickly show what a lot of people don't realize, that the reverse mortgage, the benefit amount comes in a growing line of credit. Now, I don't have my annotation tool here, so I'm just going to circle. A 65-year-old in a $600,000 house receives about $178,000 and a line of credit, a growing line of credit. Now, what happens by the time they reach 20 years later? That's grown from 178 to nearly $800,000. So the undergirding, when we talk about the reverse mortgage, folks, very important, is that when you receive a line of credit, it's growing. It's growing and accessible to you. It's non-cancelable and all these other things that I'm not going to talk about right now. And because my computer says has a performance issue. Now, based off of that, based off of these things, that undergirding, that was important for you to know. Everything else you can receive in the master class, and I'll give that to you. Brad will give that to you later. Now, optimizing Social Security. What does that mean? I'm going to try to share this screen again. There's 7 ways we're going to talk about here. Now, Brad, let's see if this can work again. All right. Bob and Sally. Bob and Sally are age 65. They're preparing for retirement. They have $600,000 in an IRA, and they have a $600,000 home. So how much of a reverse mortgage can they get based on what I just said? About $194,000. Now, here's a screen A, B, and C. It just simply shows that the line of credit is growing. It's growing here. So let's talk about ways to optimize Social Security. Number 1, supplementing Social Security. Sometimes what you get is just not enough. You're saying, is that all? Is that all?
Yeah.
Well, you don't want to take more money out of an IRA. You don't want to take money out of a life insurance cash value. You don't want to prematurely annuitize. Well, you
Yes.
can liquidate your fourth bucket, and you'll see here, if you're just listening, remember you've got this $194,000 growing line of credit, and you can nibble off of that each month. If you need a little bit more, you could even turn it into a monthly payment. So therefore, if your Social Security is just not enough and you want a little more, use your fourth bucket, the reverse mortgage line of credit, and take from that. Now, a lot of folks don't need the same amount of money every month.
Right.
So what most of my clients do, Brad, they say, well, Don, I'll just set up this line of credit. It's growing at about 7%. One month I need an extra $800. Another month I don't need but $200 more. I'm just going to nibble off of that. And that's way number 1, supplement your Social Security income.
I want to ask
Okay,
a question
all right.
because it seems like the perfect scenario with what you just mentioned for number 1. I had clients in the office yesterday. We're doing their retirement income planning. This stuff's kind of new to them. They're going to retire in about 6 months. They own some additional real estate other than their primary home, but they asked a question. They said, hey, show us what we could do with our assets like our IRAs. And this was powerful. They were Roth IRAs, so we know it's tax-free. What if we turn these on for guaranteed lifetime income? How much could we generate? So we went through our income tool and we showed them how much that would generate. We looked at their Social Security numbers, and then they said, well, that's good, but we're still a little bit short. Where should we take it from? Well, there were IRAs there, but there was also a home there with no balance on it, completely paid off, worth about $400,000. And I thought of you immediately and thought, this is a tool they don't even know that's accessible in their tool bag that they could access to fill in some gaps of income. And most people, they pay off their home and it sits there and they don't know they can use it. I know that's common, but why do you think it is that people don't realize they've got this tool in their tool bag?
They don't know what it can do. Using the home to strengthen retirement has always been a part of America. You think about the young couple that buys their first home. They don't have $200,000, $300,000, $500,000, $600,000 cash,
Right.
and they don't have any retirement savings built up. So they go and take a loan so they can begin building wealth. Well, think about what happens as they have some kids, homes need repair. They access that home again in a home equity loan or home equity line of credit, so they don't have to tap their nest egg. But now that they reach retirement, what's an age-appropriate equity release strategy? Well, all they know is a mortgage or home equity loan or line of credit. Most people don't know that they can turn the home they're in into a pile of money growing at 6-7%, and they can access those dollars. They have no idea. They've seen some commercials, they've heard some horror stories, but they
Right.
don't know the true value and potential of the reverse mortgage. And I say to folks, if you could access the equity in your home without giving up ownership or making a mandatory monthly mortgage payment, would you want to see how it works? Not will you do it, but would you want to see how it works? And again, I'll share this screen because most people don't know that this is even a possibility. If I say, now this is your home over here, we turn this home into a $194,000 growing line of credit.
Right.
And once we get to age 95, it's $1.8 million. So I say, now you've got your clients, Brad, and those listeners have typically 3 buckets of retirement they're working with. They're working with their income bucket, Social Security, pension if you're lucky, employment. Number two, your investment bucket, IRAs, 401k, businesses sale, house in the Hamptons. And and your third bucket is your insurance bucket, fixed and variable annuities, whole life insurance. And I say, now, are you 100% certain that those three buckets are going to be enough to last you all of your retirement and maintain the lifestyle you want? Well, honest people, I think, will say, I'm not sure. I hope so, but I'm not sure. 87% have a fourth bucket. And that's what I say, Mr. and Mrs. Jones, you have a fourth bucket. If we could turn your home into a growing reserve, a reserve that's growing at 6, 7, 8%, and could potentially surpass $1 million or $2 million, if that's your fourth bucket, if we could do that, and it could lengthen and strengthen those other buckets, would you want to see how it works? I think, Brad, most reasonable people listening and watching would say, yes, I'd like to see how that works. It may not work for you, may not be in your best interest, but most reasonable people, who wouldn't want access to another bucket of money, particularly as an insurance policy? Who wouldn't want to insure their retirement income?
Absolutely. And that's what we focus on the show. So Don, tell everyone real quickly, we're going to do this a few times throughout the show, but how can people reach out to you if they want to learn more information about this?
I'm going to give them, write this down. I want you to go to the masterclass, www.housingwealthmasterclass.com, www.housingwealthmasterclass.com. Then that's going to give you an educational overview. And through that, you can contact me, but you can email me at askdongraves@gmail.com. You can do that, askdongraves@gmail. But I want you to watch the masterclass because Brad and I, there are 52 strategies. We're just going to talk about the reverse mortgage strengthening strategy. But for those listeners, I want you to be able to get a more comprehensive view, and I want you to be educated. So housingwealthmasterclass.com.
Fantastic. And friends, if you need to reach out to us, if you want to come in to learn more about this, just call us anytime at 866-780-SAFE. That's 866-780-7233. And now Don's going to tell us about number 2 and number 3. So Don, take it. Let's go from there.
Well, we talked about supplementing Social Security with this reverse mortgage growing line of credit. Number 2, how do you strengthen your retirement planning? Well, deferring benefits, deferring your Social deferring taking benefits. And I know that's something you talk about, Brad. Now,
Yes.
Not everybody can do it, and maybe not everybody should do it. But what happens if you can defer taking Social Security from age 62 to 70? Well, that Social Security benefit amount is going to grow about 8% per year. But here's what happens. The client says, Brad, I'd like to do that. The higher wage earner, the husband says, I'd like to do that. But something happens at age 65 where they need income. And they can either turn on their Social Security or they can take money from an IRA or some other way. And I said, now remember, you've got a fourth bucket. So instead of taking money, and I'm going to share my screen again, and I'll talk it through for you on the radio, and so you can see it in your mind. But instead of taking money out of your IRA or some other source, you can use your fourth bucket, right? So on the screen here, I'm just showing this growing line of credit. So, Don, I want to defer my Social Security for 5 years. And I said, well, let's look at your reverse mortgage bucket. It's $194,000, $200. You see that, Brad?
Yes.
And the first year. And over here, column C says, Don, if I wanted to take that money as a monthly income for 5 years, how much could I get? I said, you're going to get about $3,861. And those are after-tax dollars. And I said, so if you're creating a bridge, I need to create a bridge from age 65 to 70. I said, well, we can use these dollars, let your IRA money stay intact, let your Social Security grow. I had an advisor, and this is what he wanted to do. He says, Don, I've got a client, age 65, and we want to defer their Social Security to 70. If we do that, it's going to be growing at 8%, a much bigger benefit. About number 2, he had an old annuity that was vested and growing at 7%. And they wanted that to grow. And then they thought they could continue to grow his IRA of somewhere around 6 or 7%. And they put it in their software. And they said, if we're able to do this, we're going to create $665,000 additional dollars just by making this simple strategic move. So if you're trying to defer your Social Security, but you need income, don't get off the program. Consider using the fourth bucket to do that. Now, the third way is when cola is not enough. Now, I'm not talking Coca-Cola. I'm talking about the cost of living adjustment. Now, how many of you listening to me, every time they come out with the cost of living adjustment, you're just slightly disappointed?
Sure.
It's all on the screen, I often tell folks, now what's your PIR? They say, Don, what's a PIR? I said, your personal inflation rate, not the CPI, not what you hear on television. They said, well, inflation was 2, 3, 4%. A few years ago, they said, oh, it's 7 or 8%. I said, that's not your personal inflation rate. I said, what did you pay for a haircut? I said, well, I used to pay $10 and I don't have a lot of hair, but after COVID, my haircut was $18.
Yes.
That's 80%, right? What did you used to pay? So your personal inflation rate, what you really experience is different. And what happens is your COLA adjustment from Social Security is this green line, and what you have in the middle is a gap. So the gap is what true inflation is for me versus what they gave me, and it's just not enough. So what do? When you've got a COLA gap? You use your fourth bucket. You turn to your reverse mortgage line of credit and you say, this is not enough. Well, good. You've got this growing line of credit. Nibble off of that. 194,000, whatever your number is, whatever it is, it's going to be growing. And I say, nibble off of that. The months that it's not enough, just go ahead and reach over there and grab some. And that becomes your COLA adjustment. Isn't that profound, Brad?
That's good. Such good information. My good friend Ed Slott says the number one thing that will separate you from the retirement of your dreams is taxes. So let's talk about the tax torpedo when it comes to retirement planning, Don. Let's talk about the fourth way to improve your Social Security using a reverse mortgage.
So taming the tax torpedo, taming the tax torpedo. About 40% of people who get Social Security must pay federal income taxes on their benefits. Now, for many folks, well, I thought my Social Security is not taxable. Well, it is taxable. And based on your combined income, your provisional income, if you go over certain thresholds, you're going to be taxed. So I'm going to give a simple case study. I'll talk it out for those listening on the screen for those who are not. Barbara's 72. She receives $24,000 a year in Social Security benefits and needs $20,000 from her IRA to cover her living expenses. And so we calculate her provisional income, half of her Social Security. IRA withdrawals, so her total provisional income is $32,000. And at this level, 50% of her Social Security becomes taxable. However, and this is very common, and Brad, this is your wheelhouse, you jump in and interrupt me when you want. If Barbara needs an additional $10,000, and that happens, she draws it from her IRA for a vacation. Her provisional income is now raised to $42,000. Uh-oh, she's gone beyond the threshold.
Correct.
This means that up to 85% of her Social Security benefits are now taxable. So what did that $10,000 she took extra resulted in a $444,000 tax increase. Well, Brad, there's no 44% tax bracket. How does she end up paying that much for that extra $10,000? That's because she went over some thresholds and it was impactful. Now, what could she have done? Well, what she could have done, instead of withdrawing the $10,000 for her vacation from a taxable account, she could have used her fourth bucket. She could have taken that money out of her reverse mortgage bucket and avoided at least $2,000 of that taxes, right? It's about managing too much taxable income in retirement. And she took out too much money from a taxable account, and that caused her to go over her Social Security threshold, and that meant she was taxed at a higher level. I said if she had a different bucket to draw from, that would avoid that. Now, part B of that is this. The tax torpedo is this. Oh my gosh, I've taken out too much money, or I simply have too much money. I can't control it. I've got too much taxable income, and I'll share some things we can do about that in the next segment. So what happens? My Social Security gets taxed. Maybe I was unaware of that. Now I've got a hole. I needed income, but I just blew a hole in this because of this extra tax. So what do? I go back and take more money out of a taxable account, which causes that money to drain faster. I think David McKnight says 5 to 7 years faster because I'm taking money out to fill the hole that I created by having too much income.
Right.
Well, it's a repeating cycle, and it's going to blow up your bucket or your retirement savings. The same principle applies. If you find yourself being taxed at a higher rate, either because you took out money for something or you just have too much money, don't fill the gap by taking out more money from a taxable account. See if you can find another source to fill the income gap that you need. Now, what has Brad and I been talking about? That other source is your fourth bucket. Turn to your reverse mortgage bucket to fill the income gap you need instead of taking it from another account, and that's going to preserve your savings. So, Brad, what would you add to that?
Well, I would say this. I call what you're talking about the ever bleeding ulcer. And so we know about an ulcer. You
Oh,
get that pain, you're like, oh, and then it keeps coming back. You eat the wrong food, something happens, oh, my ulcer. And it keeps acting up when you do this. So here's an example. Kids get left money by their parents. They don't have a very good education regarding financial things. And so dad leaves them a $500,000 IRA and they're like, perfect, I need to go buy this new home I want. I'm going to take 150 grand out of it and do that. And they don't learn until next April 15th that they just created a massive tax problem because that's $150,000 that came out of a tax deferred account on top of their earned income with them and their spouse. And so next April 15th rolls around and they're like, well, I don't have the money to pay the taxes from that distribution from the IRA. What am I going to do? And like you said, they go to the only thing they know is to go back to that IRA that was $500,000. Now it's 350. And now they take more money out to pay the taxes. And guess what? When they do that, next April 15th, they're going to owe taxes on the distribution they took out to pay the taxes from the first distribution. It's the ever bleeding ulcer that never slows down. So we want to make sure, like Don is saying, our key role is when someone calls in and says, hey, I need to take a distribution. We're going on vacation. We had an expense. We've had a lot of storms in the Ozarks. We had some roof damage. Some trees fell down in the yard. Great. Where to take it from is a very, very important thing. You don't just reach in and grab from anywhere that you can get your hands on. We want to take it from a tax-free source. So tapping into this fourth bucket, the reverse mortgage, the line of credit, a Roth IRA, anything that's tax-free would be a better choice.
Absolutely. And 87% of retirees have a fourth bucket, but most of them don't know what's in it. And I once got a notification from Principal Financial, and they said, what do you want to do about this money you have with us? And I thought, what money do I have with you? Well, I had an old 401k from back in my Wells Fargo day that I thought was rolled over. I didn't pay any attention to it.
Sure.
And I get this call. And once I found out that it was true, wasn't a scammer, once I found out I had money, Brad, you know what my next question was? How much is it? Well, it was a big number, embarrassingly so. It was bigger than I would have liked to admit. But if I told you listeners or viewers, you're sitting on a pot of money. Absolutely. And it's growing. It could be growing at 6, 7, 8%. Wouldn't your next logical question be, well, how much is it?
Yeah, that's right.
That's what you want to know. If you're listening to this or watching it, don't go through this segment and not know what you're sitting on. Whether you use it or not, at least know. And that's what Brad is talking about. That's what I talk about. Find out what you got in your bucket. If it's helpful to you, great. You know it's there. You know you can use it. If it's not, at least file it away somewhere. Put it in with your will and your special papers. Hey, I've got $249,000.
Yes.
That's accessible to me. Right?
Friends, I'm in the middle of a move right now. I'm moving from one farm to another. And actually this weekend, I'm making 4 trips back and forth. And I have these tool buckets that I take to any farm that I've got. And they're pretty nifty. It's just a 5-gallon bucket, but it's got a tool belt all the way around it. And you put your tools inside it. And when I was moving stuff for getting ready for this weekend, I found a tool. It's a rare tool that you can use on just about anything under the sun. And I've been looking for it. Couldn't find it. And I was like, there's that tool. I wish I would have had that a week ago when I was taking baseboards apart and I was moving things with carpet and doing some things with doors. Having the right tool is very, very important. If you don't have it, you can't use it. Losing it's not a good thing either. I'm glad I found it, but we're here to show you the right tools you can use to create the best retirement income plan for you and your family. Call us anytime. Our number is 866-780-SAFE. You can call and ask for a free financial consultation. We'll do a review of your current plan, and we'll help discover tools that you don't even know you have in your toolkit. Now we're going to talk about Part 5 and Part 6 a couple of more ways. So Don, share those with us.
Number 5 I'm going to talk about is managing too much taxable income. Now, there'll be Part A and Part B of this, but this is, 25 years of doing reverse mortgages. This is the number 1 application of the reverse mortgage tool, managing too much taxable income in retirement. So what happens? Steve and Barbara, they've got a $500,000 traditional IRA, and they want to take out $35,000 per year beginning. Well, that's pretty aggressive. Their advisor says, that's a bit aggressive. How about $20,000 to start? Now they're mad. No, we didn't work this hard to only take that much. Now, like 68% of the American retirement population coming into retirement, they have some sort of loan on their property. They've got a $200,000 mortgage, and every month they're paying $1,500 a month principal and interest. So see the problem, folks. They want to draw out a certain amount of money in retirement. And this is going to go back to managing taxable income and Social Security taxation. So their advisor makes one suggestion. So there's a gap here. There's a gap. They want $35,000 a year, and the advisor says $20,000. So we look at a reverse mortgage. So based off of the age of the youngest borrower, value of the house, and current interest rate, they're eligible to receive $224,000. Now, the first thing the reverse mortgage has to do is pay off that outstanding mortgage or loan of $200,000. We do that, and they've got $24,000 growing line of credit left over. Now, that's not exciting. Let's talk about what is exciting. Remember, the reverse mortgage, first of all, eliminates a $1,500 mortgage payment, principal and interest payment. It was Ed Slott, Brad, who first said, Don, if we eliminated a $1,500 a month mortgage payment, how much are we saving the people? Now, I thought, I've never met this guy, but he should know the answer to that. And I said $1,500. And he said, no. He said, see, they're taking money out of their IRA.
Yes.
And so it takes $1,900 pre-tax to net $1,500. He says, so take the $1,900, multiply that by 12, you're going to save them $22,000 retained in their retirement savings. Well, that was an eye-opener, right? So now by eliminating a monthly mortgage payment, we've now kept $22,000 in the retirement plan. So they can reduce their draw. Remember, they wanted $35,000. The advisor wanted $20,000. Well, since we've eliminated this mortgage payment, they don't have to take out $35,000. They're going to live like it's $35,000.
Right.
But they're only taking out $13,000 a year. That's going to extend the life of their savings. Here's the big thing. Now we've reduced their taxable Social Security income. We've reduced it by $22,000. That's going to have a tremendous impact. So listeners or viewers, if you or someone you know in retirement is carrying a mortgage payment in retirement, there are 10 benefits to eliminating that. This is just a few of them. But one benefit is not only just more cash available to you, but less taxation if you're taking money out of a taxable income. Sometimes you just have too much money coming in, Brad. You did well in retirement, and you've got a lot of provisional income. So Bob and Sally are the next couple we'll talk. They've got $1 million. In a traditional IRA, and they've got a $650,000 home. And so you talked to them, Brad Pistole. He said, well, we need to get this money from being forever taxed to never taxed. Right. And they said, Brad, how are we going to do that? And they said, well, let's consider a Roth IRA conversion. And so we're going to move some taxable dollars to a Roth. And you figure it out. And they said, well, let's do $100,000 per year. And they said, that's great. Well, when you do that, you're going to have to, that money is going to be taxable, ordinary income tax. Right. So they say, Brad, where do we get the money to pay the income taxes on this conversion? Do we get it from the $100,000? That means we only rolled over $78,000. Or do we take it from some other asset? Or do we use this reverse mortgage? Brad says, well, let's consider a reverse mortgage a line of credit. So what they did, and they set up that $194,000 reverse mortgage line of credit. It's growing by $14,000 a year. And then from that reverse mortgage, they paid the taxes, $22,000. And they did that for 10 years. So at the end of 10 years, if that money was growing at 8%, they've got $1.7 million in tax-free dollars at the end of 10 years. And so now we've gone from forever tax to never tax, and we didn't have to use the asset itself to do that. And again, I tell folks, isn't that a wonderful conversation? If you've got too much provisional income coming in, well, you can use the Roth IRA conversion strategy, but you still have to figure out the best way to pay the taxes. Yeah. I'm not saying that a reverse mortgage is the best way, but it should be included in the conversation. Brad, would you agree?
Absolutely. And you touched on something that was so important. People may not realize if they pay their home off, they're saving $1,500 a month in the example you used. But I will say, like Don says, wait, where were you getting the money to pay the $1,500 payment from? Oh, well, from our 401ks and IRAs. Well, then if you're using your 401k and your IRA, you're saving way more than that because of the taxable impact of taking the money out to pay that $1,500 payment. Like Don said, you may have to take out $1,900 or $2,100 a month to net that $1,500 payment because of the taxes involved. So Taxes, the number one thing that will separate you from the retirement of your dreams. It's not how much you make, it's how much you keep after taxes that counts. Don, share a couple things more with us as we wrap up here, what you want our listeners to know.
Let me share two final ways, and they're not as intense, but managing IRMAA shocks. IRMAA, that's a word I hadn't heard. I said, who's she? I haven't met her.
Right.
And they
And
said,
IRMAA.
IRMAA it says, Don, when you get Social Security, you've got Medicare Part B and Medicare Part D, and Social Security takes out money, and that's all based off of your provisional income.
Right.
And that has a threshold, and it's the income-related monthly adjustment amount. And I'll give a quick study because it's something that many people didn't know, including me. So for those who may have a higher modified adjusted gross income, there could be some challenges. So we've got a lady here, single lady, and she's nearing the $103,000 threshold. She needs $20,000 extra this year for expenses. If she draws that $20,000 from a taxable account, her MAGI, or her modified adjusted income, is going to increase. That means her Medicare premiums, Part B and D, are going to increase. That's going to reduce her Social Security check. So what does she do? Well, you all know the answer. Instead of taking that extra money from an IRA, she just takes it from the fourth bucket. That avoids a lot of things, and that avoids this IRMAA surcharge. The last thing is replacing spousal income after death.
Yes.
And 3 out of 3 die, but none of us get out of this thing alive.
Right.
And so what happens when your spouse dies? I said, well, Don, usually get the Social Security remains of the higher income earner. And I say, well, is that going to be enough? Is that going to be enough? Well, no. Traditionally, it's not. You lost Ralph's income, or you lose that. Now you've got one check coming in, but the other expenses remain the same. Your taxes didn't get cut in half. Other things didn't remain. So how do you replace spousal income? One way to do it is to say, I've got this fourth bucket. I've got this reverse mortgage line of credit. I set that up when I was 65. Bill died at 85. I've got $800,000 in here. I can use that to supplement that income. And so those are the ways, of 7 ways, of supplementing Social Security. Let me put it up on screen here. Supplementing Social Security, deferring benefits. So if you need to defer your benefits but need to replace income. When COLA is not enough, you can take your COLA from your fourth bucket. Taming the Tax Torpedo. If you get taxed, you've got too much money, don't go back to your IRA to replace it. Use another bucket. Managing too much taxable income, either doing a Roth conversion or eliminating a monthly mortgage payment. Managing IRMAA shocks, and replacing income after the death of a spouse. Those are 7 strategic ways to use the reverse mortgage to strengthen Social Security.
Don, thank you so much for joining us today. Thanks for watching. Have a great day, and God bless.